given what we've known so far, even if we were to have a vaccine that works middle of next year and we reach herd immunity maybe third quarter of next year, what's the likelihood that actually pushes up inflation?
Well, that is the big risk factor that we also see. But we do see that the most imminent sort of issue is actually what does that mean to yields? I mean, if we have a strong recovery, which we expect next year, combined with surprises to inflation expectations, not about actual, but if the market gets scared about inflation expectations in general and say we have turbocharged our way into 2021 with stimulus, with growth, and also pent-up inflation expectations, that's the real risk for markets. I don't have that as a main case. We're still sort of decently, cautiously risk on in equities, emerging equities, credit on the emerging side as well. But it is the number one economic risk that I think is out there for markets is surprise inflation expectations.
Is that priced into the markets, Michael, or some of the concerns out there, or is it being ignored?
No. It is not at all, in my view, priced. I think what we're seeing now is perhaps potentially a bottoming of real yields. With that and derived from that, actually inflation expectation could be flawed as well, and therefore there may be a risk out there for, say, mid next year. It is not priced into markets, and if there's something I'm concerned about, is sort of a little bit that we're in this 2017, 2018 scenario where everybody felt we had a fantastic rally, everybody's bullish, everybody says risk on, we're going to come out of this, and boom, yields go up more than we expected, mostly because of inflation, as happened in February 2018. And guess what? That will also reset central bank thinking, because the number one thing they don't really need now is rising inflation expectations.
But Michael, what does it mean so how do you adjust your portfolio to take all of that into account?
Well, first of all, you have to just be realistic and say, look, you have to be risk on. There is huge pent-up investment demand across the entire institutional world. Many long-only investors have completely missed this rally. They want to get on it. They want to get into it. They're looking for dips. These dips are very shallow. We saw September, October ones being more meaningful, but we're steering into the year end with still tons of liquidity on the sidelines, and I would not be on the wrong side of that, but still be pro-risk, but just have as a risk scenario, you need to be short duration, you need to prepare for steepening yield curves, and play it more with an asset allocation shift out of bonds and into equities.
Michael, what do you do with healthcare? So we'll talk about AstraZeneca in a second, but is this industry going to go through massive disruptions in 2021, or have we already seen like peak valuations?
I think, look, given what has happened in 2020, healthcare and the healthcare sector has been reset, and I think you'll see huge new investments, M&A activity into this sector to prepare for something similar to COVID in the future. Immunology, study of viruses, vaccines, and so on will be a mega trend for years to come. I mean, let's be honest, the reason why we're coming out of this hopefully faster than we thought on the vaccine front was that the healthcare sector has been preparing for this for 20 years, but they didn't have the virus to get ready for, and now they have it. That's why we are so fast into this. But I think this is just at the infancy of developments, and therefore I would secularly be long healthcare for sure.